Move on to 6.2, our 9-10 item, consideration of the December 31st, 2022 report of Lake County Pooled Investment Treasurer Tax Collector. And there they are.
Good morning. Patrick Sullivan, Treasurer Tax Collector. Thank you for allowing us to make this presentation this morning. I have Carlos Oblitas here from Chandler Asset Management, who's prepared to go ahead and give this presentation. They're adding me as a panelist right now, so if I can just have a moment, I can put this up on the board. And the panelist upgrade is not working. I'm still in as an audience member.
Is it the PDF that's on the attachment that you're looking to bring up? Can I share that for you?
Yeah, if you can, if that would be easier.
Looks like you're
Oh, I think they may have added me here. Okay, I am now sharing the screen.
Supervisors, let me update you on the status of the portfolio and the events in the economy that are driving current returns, earnings, and the risks to the portfolio going forward. Just as a reminder, as always, this is the county's investment pool. The pool has participants in the pool. The pool is designed to provide liquidity to the participants, and county money is also invested in the pool. The objectives of the county pool are safety, followed by liquidity, followed by return. That's dictated by California government code. The types of investments that you're able to make are highly controlled and restricted. Primarily, you are a bondholder, you invest in the bond markets, and the primary driver of your income is interest income from the bonds that you purchase, meaning the money you lend. Having said that, your portfolio is always very subject to whatever's happening with interest rates in the overall market. Those interest rates have been on the rise for a number of reasons. I'm going to cover those in a moment. I'll cover what's in the portfolio right now, what you're yielding currently, and then of course I'll take any questions that you may have. To give you an idea, I'm just going to flip forward. Right now, the big focus in the market is, I'm going to forward one more page and looking at the chart on the left-hand side, the focus is still on inflation. You've probably heard this over and over. A lot of you are dealing with this at the gas pump. You're dealing with this in food, and just nationwide inflation still continues to be strong. The charts that we have here were prepared for the data through December because that's the data that we always present to you on a quarterly basis, and this meeting or this presentation was pushed back a meeting. But to bring you up to date on those numbers, the last movement went from for Consumer Price Index, which measures change in prices nationwide, widely followed index went from 6.5% year-over-year price growth down to 6.4%. It's still in the right direction, the right trend, but not enough for most economists and investors. They were looking for inflation to come down a little more. If you remember our prior conversations, the central bank in the United States, the Federal Reserve right now, is in the midst of trying to combat price growth by tightening access to cash, to liquidity, and they do that by raising interest rates, by making it more expensive for businesses and people to borrow money. That way, people that can't afford debt service get out of that, and they're not pushing prices up through their increased demand for goods and services. So inflation is still elevated. If you look at the personal consumption expenditures on the right-hand side, that's the Fed's preferred measure of inflation. It's a little bit different. It factors for substitutions and things like that. For example, when beef gets more expensive, people switch to chicken. That index tends to handle that a little bit better, and the Fed prefers to look at that. That index went up. It went in the opposite direction. It went up to 5.4 from 5.3 year-over-year price growth. So we're still seeing some challenges in the price, at least in the battle against prices by the Federal Reserve. One of the things that's a big driver of that has been job growth. We've talked a little bit about that in the past. Nationwide, the job market in the United States is still very hot. This chart does not show it, but we've been generating somewhere around 200 250,000 to about 180,000 jobs per month. We only needed about 110,000 pre-pandemic to absorb new entrants into the market. The last jobs number that we had was from the month of January. That job number, the job number came in at 517,000. So it blew the doors off of any expectations. They were expecting 180,000. They got 517,000. That level of demand for labor is pushing wages up, which is in and of itself inflationary. It's good to have a job. Some sectors are doing better than others. You're probably hearing a lot about the tech sector laying off, and that's definitely true. Most of the gains have been in services and have been in hospitality. If you think about the jobs lost during the pandemic, we lost somewhere around 23 million jobs. We've brought back over 23.5 million jobs. We're now creating more jobs than what we had pre-pandemic, and that's the kind of environment that we're dealing with. That dynamic has led the unemployment rate to be and hover down around 3.4%, which is very, very low. It's not a record, but it's at a point where economists call it like a terminal rate of unemployment, where any lower employment is just inflationary. It's just going to add to more inflation because of the demand is going to push wages higher. So it just means that the Federal Reserve has been focused on driving prices lower. They do that by raising rates. The rate that they move, that they manipulate, is the overnight lending rate between banks in the United States. That's called the federal funds rate. They have a target for that rate. That target is currently set at 4.5 to 4.75. Right now, if you look at the chart in front of you, it's hovering right around that range. They meet about every 6 weeks. They met last on February 1st. They determined they wanted to raise that target rate by another 25 basis points. That's 0.25%. That's a lower clip than what they've done in the prior moves in 2022 and the beginning of 2023. They've been raising it at 75 basis points a clip. So they've slowed down, but they're still moving to raise that rate. What does that mean to you? From an economic perspective, it just means that borrowing is costlier, and that gets passed down to you from the banks, and that gets passed down to consumers. And that's the purpose of doing all of this. The Federal Reserve is cutting off liquidity. They're reducing the money supply so there isn't as much money exchanging hands as quickly, driving those prices up. The net effect of that, of course, is that it's supposed to slow the economy down. It could slow it down to a point where we get into a contraction, a recession. We're not there yet. We did have a couple of quarters of negative growth. It wasn't officially a contraction because a recession is typically 2 quarters of negative growth. They did not officially call it that simply because we just have such strong employment numbers, and it's hard to call a recession when people are well employed. All this to say is that we are seeing some weakness in the economy. You can actually see it in housing starts. Housing starts are slowing down. You can see home prices have come off nationwide. That may not feel like that in California, but certainly nationwide. They've come off. The chart on the right-hand side is showing you the change in year over year in price growth for houses. At its peak, we were looking at year over year 21% price growth nationwide average. Today, that's even lower than this. It's closer to 6%, but it's still growing. Prices are still growing. I mentioned a slowdown. Manufacturing, you can see, is looking at the Institute of Supply Management Purchasing Managers Index. That's a diffusion index. It's a survey where they take a number of factors in to index it in an index of 0 to 100, and if you're below 50, it's contracting. You can see that manufacturing has definitely contracted. And of course, people are always looking at consumer, just looking at retail sales. You can see that retail sales have been on the slowdown. So the moves that the Fed is doing the net effect has been to slow the economy down, but prices have been persistently high. Part of that is labor. What does it mean to you and your portfolio? Well, it means that with the Fed being on the side of raising rates even higher, it means that rates in the market that are available for debt instruments that you purchase, the rates are going to be higher. And that has a dual effect. Whatever debt instruments you currently hold on paper go down in value. And that's been happening all of 2022 and now the beginning of 2023. That value, that drop in value is not generally realized because for the most part, we hold these investments to maturity. We hold them to maturity. At maturity, you get your money back, and we turn around and we reinvest it. That reinvestment, that's the second part. That reinvestment is at increasingly higher yields. To give you an idea, I'm just jumping forward to give you an idea. Looking at September 30th, we were earning 155% per year. That's the annualized earnings rate expected going forward. That number climbed to 182. The reinvestment rate, so whenever we received new money or on maturity, we reinvested it at 3.63 3 months prior, and as of December 31st, we were getting in at 377. The nice thing about all of this is that reinvestment rate today, if I looked at a report as of yesterday in the portfolio, we were looking at yields of around 5%. So any new money we're getting in, we're picking up 5%, which is driving that average yield higher. Currently, that average yield is higher than 2%. So we're moving in the right direction from an earnings perspective. The valuations are still lower because, remember, when rates rise, the values fall, but that drop in value generally is not going to heavily impact you because most of this is held to maturity. Right now, the portfolio is valued at $465 million. This includes the component that Chandler Asset Management manages on your behalf. It also includes the component that's in the bank that's used to make payrolls and to make liquidity for participants. It includes money that's in the state pool, local agency investment fund. You're very well diversified. Let me jump forward to that. You hold almost every asset class that's allowed to be held by code. There are a few that we don't buy simply because we're just not finding value. But these asset classes are in the portfolio in the proportions that you see because of the analysis that we've done to make sure that we, if we're picking up additional return, we mitigate the risk that's associated with that. You're very well diversified. And then from a maturity perspective, again, this includes not just the assets that we manage on your behalf, but there's considerable liquidity. The green bars are as of December, the gray is as of 3 months prior. You can see that you had it looks like 3 months or less, about 27% of the portfolio was available. This was at a time period in December when the county was collecting property taxes. So you saw a great increase in the shorter component of the portfolio. Subsequent to this, a lot of that money goes out. It gets passed down, sales tax revenues, property tax revenues to the component cities. Your participants take the money, the county uses up money. You're going to repeat all of this in April, again when property taxes are due again, once again in April 10th, and then thus goes the cycle. But again, the key things here are we're trying to manage the risks. The risks right now are that rates continue to go up, and that continues to devalue, and we've mitigated that by mainly holding to maturity. We periodically rebalance. The other risk, of course, is that the economy the odds of a contraction are increasing, and that puts pressure on financial systems. It puts pressure on debt issuers. It's more costly for them to issue debt. So this is the time when we moved. We're always high in credit quality. This is a very high credit quality portfolio. So the strength of the issuers that you hold here are very strong. But we always like to move more towards liquidity. And when I say liquidity, I mean sectors that are widely held, that have strong secondary markets, that people will always demand them. That means treasuries and agencies. And you can see those make up the bulk of the portfolio. Treasuries make up almost a third. Agencies make up a little bit, well, almost a fifth of the portfolio. Very liquid, very high credit quality, and very well diversified. Let me stop there and take any questions you may have.
Supervisor Spatier.
Thank you for the report. Got a couple of questions. One, just looking at that chart, I'm glad that you brought it back up. So I know the LAIF is the statewide investment pool that we are a part of. What's the difference between that and local government investment pool? Is that our own personal one? Because it says 0.0, so I'm just kind of curious as to what that is and why it's there.
There's about $8,000. We don't have enough decimal spots in the chart to capture that one. That's an astute observation. So LAIF, L-A-I-F, is the Local Agency Investment Fund, which is the state pool, as you correctly stated. Local government investment pools refers to another investment pool that the county has the ability by law to invest in. It's called California Asset Management Program. It's a joint powers authority that runs a trust which sponsors a pool. That pool is about $6 billion. It primarily holds bond proceeds money. It's administered by another company, but it's officially owned and operated and governed by a joint powers authority made up of local public agency officials just like you.
Okay. Thank you for that. My next question is, if you can go to the slide for the maturity years. Yeah, that one. So I guess I need to be reminded. I remember when we worked on the policy, I thought we were aiming for 3 years, and I'm starting to see that there's the 4 to 5 years starting to have some. And now in comparison to my judgment on what needs to happen, I trust your judgment a whole lot more, since we are definitely seeing great benefits from working with you and your agency to invest in the right places. But can you explain the 4 to 5? Is that part of the policy that we did approve? I know we wanted to get there at one point. I did not expect us to be there so quickly.
Supervisor Sabatier, and I have to tell you, I'm thrown off because your name cards are switched.
Oh,
but
am I not Sabatier today?
and I just happen to know that you are Supervisor Sabatier.
Oh, yeah.
So
Thank you for that.
No problem. No, again, another good observation. The investment policy allows us to go up to 5 years maximum, which we try and take advantage of whenever possible. The strategy that we worked in place with the ad hoc committee that you and Supervisor Pyska were a part of, as well as the current treasurer tax collector, the decision at that time you correctly identified was that the strategy would be that the bulk of the investments would be held between 1 and 3 years. The bulk of them. And that's on the investment portfolio, the part that's managed by Chandler. Obviously, there's other funds that are kept much shorter because they're in the state pool and they're needed for liquidity. And that's included in this chart here, which you can see is sizable because the county collected taxes at that point and it built up. But that's correct. The bulk of the investments are to be maintained between 1 and 3 years, not all of them. We do look for opportunities beyond 3 years when it makes sense. The average duration of the portfolio, between 1 and 3 years generally, when you look at an index of bonds between 1 and 3 years made up of treasuries and agencies, the average duration tends to be somewhere around 1.7, 1.8 years. So we try and stay, when we build this up in the portfolio, it tries to be somewhere around 1.7, 1.8 years. Sometimes we can maintain that average by maybe picking up a little bit more if we see some value longer. It's interesting that you say that because right now, the yield curve, that's a fancy term, that's the term structure of interest rates. If we looked at interest rates of treasury securities that are offered at 3 months, 6 months, 2 years, all the way out to the spectrum of maturities. If we looked at what's offered and we charted that, and that's a curve, and you're looking at it on the right-hand side, normally that curve is positively shaped as it was December of 2021, when you can see the bottom line here, it's positively shaped, when rates were much, much lower. If you look at those rates through December, the green line, the curve is inverted. And that's another, again, fancy way of saying that right now, shorter maturity bonds are paying a higher yield than longer, which your next logical question would be, why would we buy that longer bond? Generally, when you see an inverted yield curve like this, it's because investors are expecting a contraction. Since the 1960s, an inverted yield curve like this has a very strong correlation with a contraction following anywhere from 18 to 22 months forward. And so investors will buy up longer bonds expecting that rates will fall. Remember, prices and yields move inverse to one another. So if they're buying up more bonds in longer maturities, they're driving up the price, which pushes the yield down, creating that inversion. And of course, on the left-hand side of that chart, that's driven by what the Fed is doing, which we talked about. They've been raising rates. The yield, the market is not keeping up with what the Fed is doing. So why am I telling you this? I'm telling you this because if it's expected that there might be a contraction, and the numbers are showing us that. And if that happens, eventually the Federal Reserve will have to start doing the opposite of what they're doing now, lowering rates. And if you have longer maturity bonds where you pick up some sort of yield, you hang on to that yield much longer. You're not, if you keep it much shorter, right now logically you might want to buy shorter maturities because they pay more. Those shorter maturities will mature much faster, and if yields come down because of a contraction, those investors are forced to reinvest at lower yields. So this is why we diversify these maturities just like we diversify the sectors, and that this is why we have investments that go out, some of them out near the 5-year range.
No, I appreciate the explanation. I know that the longer the term, the more risk, but also the more potential. It kind of goes both ways, but the explanation of the timelines of what's historically been seen and the fact that there are forces that can change what the outcome of the economy is, that those actions will be taken, that makes sense to me. And I did have one last question. I know I asked Mr. Sullivan this. Obviously, the most important part for all of us is not just where is our money, but what are we benefiting from this? And you've already shown the yields, but I know that we get quarterly interest that comes in. That interest goes to not just Lake County, it goes to our schools, and it goes to our fire districts. I'm not looking for that separation, that level of detail, but just to kind of understand how we've been doing as far as the interest that we've received from placing these funds in the appropriate locations.
Yes, I was aware of your request, Supervisor Sabatier, and I did prepare this chart just to try to outline that. This is the last 2 calendar years of the quarterly interest that was earned. So I hope, is that visible up on the screen? Okay. So if you look back to the beginning of 2021, this was before we were using Chandler Asset Management, and most of our funds were in our operating account or in the state pool, which at the time was not paying any significant returns. As you'll note, as we got closer to the end of 2021, in that fall, we engaged with Chandler and we began to enter the market. So you'll see these returns start to climb. By that March figure, we were fully engaged with the market. And Carlos, I don't know if you want to jump in more with an explanation.
Absolutely. There are a couple of reasons why you see this spike in investment earnings, 2 that I would attribute. The first is that prior to the ad hoc committee that came together to make those decisions on the portfolio. Prior to that, as your treasurer tax collector has stated, the funds were primarily in bank accounts to a point where and rates were so low, the banks were not paying anything, and your earnings were very, very, very low. 2 things happened. You engaged into the markets where you started purchasing interest-bearing securities with higher yields, and that bode well for the portfolio. It did well. You started seeing the earnings pick up. The second thing that happened is what we were looking at prior is that through the course of 2022 and the Federal Reserve's moves to raise interest rates have moved interest rates in the markets higher and higher and higher because of to slow inflation down, all the reasons that we just spoke about. Well, you have been fortunate in that every time you reinvest, you've been reinvesting at increasingly higher yields. And I'm going to go back to a decision that ad hoc committee made back in October, November of 2021 when we originally met. And that decision was, going back to your point, was that you were going to maintain the bulk of the investments between 1 and 3 years, sometimes even shorter, sometimes a little bit longer, but between 1 and 3 years, rather than going longer and having it mainly between 1 and 5 years. So we were looking at an option of maybe averaging somewhere around 2.5 years. We made the decision with input from the Board of Supervisors where we would go a little bit shorter because we wanted to emphasize liquidity, because we wanted to be a little bit more nimble, because we anticipated that rates would be going up. So doing that move, rather than averaging 2.5 years, you're averaging 1.7 years or so, you're able to reinvest faster. It means that on the whole, on average, the portfolio is turning over faster right now, maturing faster. There's shorter maturities which come due faster, and that faster is bringing more cash available, which you in turn have been reinvesting in increasingly higher yields in the markets, and that's why you're seeing this hockey stick. So that decision, this is proving that decision to be a wise decision. It was a good decision, and it was made in a very timely manner.
And I have one last final question. I know there was supposed to be a slow ramp up of Chandler Assets investing our funds or our investment pool, seeing that there's kind of not a flat line, but kind of a flatter line at the top from September to December, does that mean that we've reached that 100% that you're investing, or have you reached that capacity that you're looking to get to, or are you still ramping?
So we're not ramping in terms of how we're structuring the investments. We're at where we want to be. So the structure, so meaning the pie charts that you saw, the proportions in the different sectors, the bar charts where you saw the different maturities, the structure of all of that is exactly where we want it to be at this point. We're not ramping up. Because we've been working for you for a little bit over a year, and we're already there from a strategy perspective. I think the reason you're seeing that, and this is a discussion that your new treasurer tax collector and I have been having, is the way that the accounting was being done. There's something to do, we're getting into accounting terms here, there's something to do with the way that premiums and discounts on the bonds are being handled, and we're working right now on a way to better handle them, and that's just the way that the data is showing through. What I do anticipate is that these yields that I showed you should continue climbing. I mentioned to you that your reinvestment was over 3 something percent, and your current yield was like 190 something, 192. As of yesterday, you're averaging 212 on this portfolio. So that it's already moved higher from December. Here we are at the end of February. It's already moved above 2%, and it will continue to do that so long as rates in the markets range right where they are. And then your reinvestment, which was something around 3.5 or something, well, that's today, as of yesterday, it was 505. So if I'm picking up new investments on average at 505, I'm going to move the average that I have higher and higher every day. That should continue. It should not plateau. That might be an accounting issue, which we're still kind of working out.
Thank you very much.
Yeah, and I would highlight a lot of that has to do with the fact that the purchases are being made on the secondary market at the discount. The figures on this chart are cash basis out of our system. So a lot of the gain that will be captured is not going to be realized until that security hits its maturity. So we're not going to pick up that cash that we gain from purchasing it with that discount until it matures, and that may be a year or two down the road. So you would see that spike later. So that's part of the other reason for the leveling you see here as compared to the Chandler report.
If you want to Google it, it's called amortization of premiums or accretion of discounts. If you're really interested.
I'll add it to my list.
There is one other point that I would add that relates to this. We are currently engaging in a restructuring of our banking structure, the way our accounts are laid out in our operating account and some of our others. So through that, we've been able to both reduce costs. We're able to eliminate the banking fees that we were previously paying. And it also will create the opportunity to create some short-term yield in our operational account, which we previously didn't have. So that's another hope that can help add to what you're already seeing in Chandler's reporting.
So do you have any expectations that we'll need to change our strategy in the near future? I know we had set up some procedures about when we should meet if you started to notice some changes that were concerning, and I forget what that was. Was it like within 30 days or I can't remember.
I don't remember.
But just given the uncertainty and things are changing, I was just wondering what your expectations were and just to remind the board what those policies we set up were.
So generally, what right now the obligation, the way that we wrote the policy, the obligation is to inform the treasurer tax collector if there are credit issues. If something's happening in the portfolio where credit deterioration occurs and you have names that where we think that there might be credit action, maybe even where the credit rating agencies might lower a credit rating below the minimum requirement to purchase that security. That's something that you pay us to monitor. The Treasury pays us to monitor that. So we and of course what we're purchasing in this portfolio is we're doing credit analysis on everything that's not a U.S. government security. So that we have to notify, and we have to notify immediately. That there's no waiting for that. There's no meetings for that. That we have to jump on that ASAP. In terms of the strategy was selected from a long-term perspective. And we had two really good reasons to, when I say we, I meant that ad hoc committee that was working at the time. There were two really good reasons why the committee went this route. The first one was because it got you out of overnight investments, which is what you had, and at that time, overnight investments were paying literally nothing. So you chose to move a little bit longer to be able to pick up higher interest income, and that's why you saw the initial pickup in this chart. The second reason was because you maintained it between 1 and 3 years, was because that was a structure that we knew if anything happened to the markets in terms of interest rates blowing out and rising, and if we had to sell something, the longer that we went, the bigger that negative value impact on paper. So if you had to sell it in an emergency, your ability to do that was even more limited with a longer portfolio. This is why we settle in that in-between space. It's also a structure where if we literally did nothing but just sit and wait, we do periodically sell before maturity to rebalance, to diversify, to pick up higher credit quality. Sometimes we may sell at a slight loss to pick up a higher yielding security that pays us back for that loss and leaves us with more money than had we just done nothing. So we do that all the time. But the idea here was that if we, in an emergency, if we just sat and waited for the maturities to come in, this structure was giving us many maturities to allow us to do that. I don't anticipate this strategy to change even in this environment, because this is a very strong liquidity position and the credit quality is very strong and everything complies with the policy and everything complies with code, and you're very well diversified at this point. The only thing that would change, with most treasuries, not a ton of them go longer than this, to perhaps a 1 to 5 year where they average 2.5 years. If anything, it would be during a dire emergency where maybe we wanted to shorten the duration even more, maybe give up a little bit of yield because there were emergency needs and we needed liquidity faster. And we're not at that point right now. We're not at that point. But of course, we monitor the economy and we monitor the markets to give you a heads up to think about what we're seeing. I want to remind you that this portfolio is, in the world of investments, if you think of everything that can be bought out there, because of code and because of your risk management policies by your investment policy, this is a very, very low risk, high credit quality portfolio designed to withstand shocks to the system. That's the whole purpose of this. When compared to other investments, it's a very low risk portfolio, and that's because code requires safety first, followed by liquidity, meaning having the money available when you need it, then followed by return. You just happen to be doing it at a time when returns have been the best in about 15 years.
Great, thank you. Supervisor Green?
Yeah, thank you. I'm going to reference page 31 and then page 27 of the slide deck. And it's the peculiar creature of what's called a Yankee CD in here. So on page 31, I'm seeing we took dispositions totaling $34 million through assorted Yankee CDs. And then on page 27, I guess what we call this particular creature is a negotiable CD, and our current holdings are closer to $5 million. So that $125 million disposition kind of raised my eyebrows, but can you just give a real quick overview of the peculiar creature that is a Yankee CD? It appears to allow investments in banks that are not totally American funded. So the size of the dispositions and then our current stake in negotiable CDs. Can you just give an overview of that?
Absolutely. Those particular dispositions, I believe we inherited.
Yes, I believe the position you're referencing on page 31, the Standard Chartered Bank of New York Yankee CD, that was purchased before Chandler began managing our portfolio. We did examine it, and we made a determination not to take any action with it, to hold it until maturity, but it doesn't follow the standard practices that we would employ now in terms of selection.
And if I may elaborate on that, that's specific to that Standard Chartered Bank. That one was inherited. The Svenska Handelsbanken and the Toronto Dominion, I believe, those might have been inherited as well.
I'm not sure about that.
We do buy negotiable CDs on behalf of the county. If you think of a certificate of deposit at a bank, it's simply a deposit where you put it in for 6, 9, 12 months or whatever, 2 years. They give you a rate. You really can't get your money out without a penalty. This works similarly, except that you, rather than rather than taking a penalty if you wanted to get out of it, there are buyers. There are a large pool of buyers that are standing by, ready to buy it. They're in very high demand. They're mainly purchased by money market mutual funds, which are very low risk investments, places where people park cash. So in terms of Yankee CDs, to answer your specific question, a Yankee CD is a CD that's issued by a foreign bank which has operations here in the United States. About 95% of that market, they're issued by their US subsidiaries. And the reason the California government code allows you to purchase them is because when they do that, they're just like an American bank. They are overseen by the Office of the Controller of the Currency. They have to follow US banking laws, and they have to be capitalized to a certain degree to be able to operate. So for that reason, and on top of that, we're not just buying any Yankee CD, we're buying Yankee CDs which are very high credit quality. There's two things I'll say about that. During the downturn, the great financial crisis in 2008, 2009, these tended to do quite well because they weren't as tainted by the mortgage market that tainted American banks during that time. The second thing I'll say is that what's nice about these, especially with the longer ones, when they get longer, they resemble a corporate bond, say from Apple or Microsoft. What happens is, or from Bank of America or Wells Fargo, what happens is if there is a default, if somehow, the worst thing happens, a CD holder, a negotiable CD holder actually gets to stand in line in front of the corporate bondholders because the Office of the Controller of the Currency treats this not as a bond, but as a deposit. So that's why we like them. They're very high credit quality.
Then real quick follow-up. I assume you're just following the money wherever the rates are. So to note the prior balance, $34 million, the current holding of about $5 million, clearly as a percentage of the larger portfolio, our Yankee CD holdings have shrunk. So is that just part of the new management that you guys are bringing, or is that a changed view of the value of the Yankee CD, or is that just totally based on the rates of return? We have less exposure to Yankee CDs than we did prior.
So, Supervisor Green, that's again another astute observation. It's partially our preferences. We do chase the money, but we do that by mitigating the risk. We really view ourselves primarily as risk managers. And to your point, where you identified 5% back in December, I'm looking at the holdings as of yesterday, actually I'm looking at the December holdings, and looks like all existing negotiable CDs in the portfolio made up a little bit over 1% of the portfolio. So part of the problem was that Standard Chartered Bank that you identified there, that single issue was $25 million, and we just don't buy chunks of $25 million bonds of any name. One of the things that we did working with that ad hoc committee was to build in an issuer concentration limit of 5%, which is not even in code. That's a best practice to limit our exposure. And in practice, we actually, our exposure by name, I believe, is less than, in corporate names, is less than 2%. In some instances, less than 1%.
Anyone else? No? Anyone from the public?
There are no hands in Zoom.
Really appreciate your presentation. I can't believe the progress that we've made with both of you being so engaged in this portfolio. So thank you so much. We're in really good hands, and I'm really glad that we did that work a year ago. It's incredible.
We thank your board for your support in this.
The ROI is pretty good.
Nice.